Hello, this is Joe Slezak, Director of Marketing and Business Development for H2R CPA. Thank you for joining us today. The Q&A session will occur at the end of the webinar. We've tried to answer as many of the pre-submitted questions as possible during the presentation portion of this webinar. Please use the chat feature to submit your questions to me by selecting Organizer as the recipient of your question. You may submit your question during the program or wait until the end. Please note, since this presentation is being recorded, specific questions which contain identifying information will be filtered to protect our audience. I will now turn over the presentation to Paul to start the program. Thank you.
Thanks, Joe. Thank you, everybody, for joining us today, and hope you are staying safe and healthy at this challenging time. The tax world is always an uncertain one based on future legislation and political movement, but probably more uncertain than any time in recent memory. So we're basically going to do 4 areas today. We're going to try to give you a projection of things to be aware of that will occur based on potential legislation that has been discussed. And then Phil Zlokas, one of our senior tax managers, is going to speak on the CARES Act that was put together when the pandemic first came out. And then Lucas Rihely, a partner in our Beaver office, is going to talk about developments with the payroll protection program and how that's going to impact businesses' tax returns. And then Bill Bodnar will conclude with items on year-end tax planning and issues that you should address as you're getting towards the end of this year. So I wanted to start with changes with what could be coming ahead. And certainly the big factor will be what is the future White House going to prioritize, and what is the future Congress going to look like. I would say every single taxpayer will be affected by change. The big question is, will that change occur in 2021 or 2022? Historically, you would say 2022. That's when the change occurred in the past administration. It took them a whole year to come up with a tax bill that went in effect the following year. But with the significance of our deficit because of the pandemic and other matters, Congress may impact retroactively to earlier in 2021 or a date during 2021. And of course, a major factor in what will happen in today's political environment is the 2 Senate runoff elections in Georgia, because if the Democrats win both those races, they will in effect have control of the White House, the House, and the Senate, which would be much different than if the Republicans control the Senate, and then we will have some battles of what legislation will move forward. So the 5 areas that I'm going to cover for potential change are the state tax side, income tax rates, potential capital gain and qualified dividend taxation changes, corporate taxes, and Social Security taxes. So on the estate tax side, this is a highly publicized, highly emotional tax that over the past 12 months, according to the Tax Policy Center, applies to a very small percentage of decedents. 99.93% of estates don't owe federal estate tax. And that one reason it's political is because it has gotten to be such an insignificant number. The projection for this year is 1,900 Americans will pay federal estate tax. You just go back roughly 20 years ago, it was 50,500. So certainly come down. And one thing to keep in mind in all this, Pennsylvania is going to be static. There's not going to be any change in terms of what the inheritance tax is, and sometimes that's the biggest tax that people pay. So don't forget about that when you are considering your potential estate planning. Currently, the federal estate tax exemption is 11.58 million. And going to 11.7 million in January. So that means per person. So if you're married, you could go to 23.16 million or 23.4 million. So it would only affect the states over that amount. The dramatic item to look at is the discussion on drastically reducing this. We've never had a reduction in the estate tax exemption, but it seems very likely that'll happen. On the extreme side, people are talking about dropping that to 3.5 million. Other discussion has been to take it to the pre-TCJA number, and that would be 5.6 million. And the other proposal has been raising the tax rate to 40% once you exceed whatever limit it is to 45%. So just as a quick example, if you have a $10 million estate, remember that's all your assets, that could be your investment accounts, your retirement accounts, your house, businesses, etc. That if you would have $10 million in assets and they would drop it to 3.5 million, and 45%, you would go from your heirs from paying no tax to paying 1.35 million. So this makes gifting very important. You can gift up to 15,000 a year per person, and no reporting, no use of the lifetime exemption, currently 11.58 million. But with the exemption decreasing, the lifetime exemption, not the 15,000, this could be your last chance to use part of that limit. If they drop the limit from 11.5 to 3.5, you may not have the ability to make a significant gift in the future that could reduce your estate tax. So one of the current items that is most concerning to me is the potential elimination of the step up in basis. And the step up in basis deals with when somebody owns a security predominantly, that the capital gain goes away when you inherit it. And so you have many seniors who have a security. I was looking at some portfolios yesterday, and people have tech stocks and other highly appreciated stocks that they bought a couple decades ago, and they're up hundreds of percents. And so it doesn't make sense unless they need the money to sell them, because if they leave those to their heirs, then the heirs could sell it the day after they die and pay no tax. Well, there's been discussion about eliminating this. This would be an administrative nightmare if this would go through. Some people, don't even have their basis. One of the classic examples is those who AT&T stock that they bought years ago, and it's split a zillion times and all different companies, and people don't even know what their basis is. But so that's why inheriting it, that you don't have to worry about that. But if this all changes and the step up in basis goes away, this is a major factor. So this should cause people who have estates over 3.5 million to evaluate whether does it make sense based on what your bracket is and your heirs bracket is. Does it make sense that you should sell a stock? So if you say, well, I don't really like that stock anymore, but I'm just keeping it because I don't want to pay this huge tax, and I know my kids won't have to pay it someday. Well, that strategy might change now. You might want to look at it and say, do I like this stock anymore? And or where's my tax bracket compared to my heirs? And it might make sense to sell that stock now or gift that stock now. So the income tax rates are not specified. I think this is the least specific in the coming administration's proposal, because they've indicated that it'll be for incomes higher than $400,000. Well, what does that mean? Does that mean taxable income? Does that mean adjusted gross income? There's a lot of items that still need to be addressed, but currently the top rate is 37%. So they're looking at increasing it to 39.6, which was the rate prior to the Tax Cut and Jobs Act in 2017. So nobody wants to pay more tax, but 2.6% doesn't sound like a huge raise for a lot of people, but it's actually going to be a much higher rate increase than that, because the 39.6% bracket will begin at 400,000. So that could mean, in essence, some people are paying 8% more if they were down in the 32% bracket around the 400,000 range. So it could be significant. So this may not be one of those years where you say, let me defer income to next year if you're going to be paying 8% more tax in the future. Now, capital gains and qualified dividends have been a great way to not pay as much tax if you're in the investment world, especially we're talking about non-retirement accounts. So currently, capital gains and qualified dividends are taxed at 15 or 20% for federal IRS purposes. But one of the discussed changes has been to eliminate capital gain preference for those with taxable incomes of $1 million or more. And so that would mean increasing your taxation rate by 20 to 25% on your capital gain and qualified dividends. Well, that should give people consideration to reevaluating their taxation of their portfolios. And if you're in that range, if you have taxable income of $1 million or more, you really should give that some consideration. And what that could mean is looking at your mutual fund portfolio. And if you have mutual funds that distribute capital gains and qualified dividends on a regular basis, you could be paying 20, 25% more. So you want to evaluate, does that make sense for me going forward? Should I look at more tax managed funds, ETFs, or stocks where I can control when the capital gain occurs? And I can look at funds that don't distribute quite as much in terms of dividends. And I think it's an important part of your portfolio, because if this goes to this situation where you're going to be paying 25% more in tax, that's a big item. That's really going to reduce your investment return. So I think this will be an important piece to keep your eye on. Corporate tax rates, they were 15 to 35% pre-TCJA. They went to flat 21, which was great for real big companies making $335,000 or more. For the little guy who's making $50,000 or less, they actually got a 40% increase. They went from 15 to 21. The discussed changes, though, are to, in essence, split the old TCJA with the new, the old rate with the new TCJA and make the rate 28%. So we'll see if that happens. They're looking at doubling the GILTI tax, that's on foreign earnings, to 21%. And besides the step up on basis, the most nightmarish provision that they've mentioned is considering a minimum corporate tax for those with a book profit of over 100 million. And that might not apply to many of you, but it probably applies to a lot of companies that you own stock in. And this would just be so difficult to put together, because it's combining non-tax concepts, accounting GAAP concepts with tax, which don't always come together. So this would be really hard to do, and really would be impractical. But nonetheless, if there's going to be something of this sort, it really would give you pause to take a look at some of these high appreciating stocks. There's many new credits that are proposed, and they might be good for a lot of business, a lot of jobs credits, a lot of credits for expenditures in the U.S. We'll see if they happen, but it's something to keep an eye on as they come forward. And the last area I'm going to touch on is Social Security tax. So currently, you are assessed Social Security tax and your employer for the first $137,700 of earnings. It goes up a little bit each year. The change would be to, once you exceed 137.7, no change, but once you exceed 400, they start taking the 6.2% tax out again. And this will not increase your Social Security pool. This will just help the pool, help the issues that the country has with Social Security tax funding. So this is an employer and an employee tax. So if your gross compensation is over 400,000, and this comes into play, you really should look at your compensation arrangements, because it's going to cost you 6.2% of whatever's over 400 and the employer. So it's going to be could be a pretty significant tax to be assessed. So now I'm going to turn it over to Phil to talk on the CARES Act.
Thank you, Paul. As Paul said, I will be talking about certain aspects and tax provisions of the CARES Act, specifically those that are set to expire in 2020. I'm going to touch on the temporary suspension of the changes to net operating losses enacted by the Tax Cut and Jobs Act. I'll talk about the CARES Act and the temporary suspension of excess business loss limitations, also enacted by the Tax Cut and Jobs Act. And then I'll also talk about the deferral of payment of the employer's Social Security tax that the CARES Act put in place. Start first with talking about net operating losses. So the Tax Cut and Jobs Act made certain changes to the way that NOLs are handled. So under the Tax Cut and Jobs Act, net operating losses are no longer able to be carried back but have an indefinite carry forward. Prior to the TCJA passage, you could generally carry back losses 2 years and forward 5. The TCJA also put in place limitations on the amount of an NOL that can be used to offset income. That limitation is currently 80% of taxable income. So speaking again, prior to the TCJA being put in place, there was no such limitation. So in an effort to put money back in people's hands and business owners' hands, the CARES Act made some changes in temporary suspensions to provisions of net operating losses that were enacted by the TCJA. Under the CARES Act, for net operating losses that originated in tax years beginning after 12/31/17 and before January 1, 2021, there was no limitation on the deductibility of those losses. So they temporarily suspended the 80% taxable income limitation. And they also instituted a 5-year carryback. So they got rid of the provision, or temporarily suspended the provision of no carryback and an indefinite carry forward, and said you can take that NOL and carry it back 5 years. So what happens after 2020 when these temporary suspensions are no longer in place? NOLs that originated in 2018 and between 2018 and 2020 that are not carried back or are not fully absorbed before 2021 again become subject to the TCJA limitations after 2020. So just to reemphasize that, if you have a net operating loss that originates in 2020 and you do not carry it back to 2015 and do not fully use it, as that loss carries into 2021 and forward, it then becomes subject to that 80% limitation. The next provision that I will talk about is the excess business loss limitation enacted by the Tax Cut and Jobs Act. Post TCJA, aggregate business losses were limited to $250,000 if not married filing jointly, or $500,000 annually if filing jointly. Those numbers are adjusted annually for inflation. So basically what that's saying is that if you take they wanted to limit your aggregate business loss, the ability of those losses to offset other sources of income, be it investment income, wages, things of that nature. Any disallowed excess business losses are carried forward to the subsequent tax year as a net operating loss. Keep in mind, though, that the TCJA also put in place the 80% taxable income limitation on net operating losses. So while you're carrying that amount forward, you will be subject to future limitation. It's important to note that this provision applies to non-corporate taxpayers. Okay, so much like the temporary suspensions of the NOLs that the CARES Act put in place, the CARES Act also put in place a temporary suspension to the excess business loss limitation for 2018, 2019, and 2020. So the CARES Act was passed in 2020. TCJA changes took effect in 2028. So if you had filed an 18 or a 2019 tax return where you had a limitation due to 461, which is the excess business loss limitation, you should be amending that tax return to reflect the temporary suspension under the CARES Act. The CARES Act also provided for a technical correction in that wages cannot be taken into account when determining the excess business loss limitation. So funds received through providing services as an employee are not included in your aggregate business income and losses for purposes of determining your limitation. Post-CARES Act, beginning in 2021, the excess loss limitation will be back in place. So this again is a temporary suspension for 2018, 2019, 2020 tax years. The CARES Act also put in place a technical correction to the class life of qualified improvement property. I'm sure you've all heard of it. At the time, the way Congress wrote the law, they inadvertently changed the class life of QIP property to 39 year. It was previously 15. It required action on the part of Congress to fix that, which they did with the CARES Act. So that change from 39 year to 15 year property retroactively applies to property placed in service in 2018. That's important because that property is now eligible for bonus depreciation. Bonus depreciation is able to be taken on a qualified property that has a class life of 20 years or less. With the QIP being in the 39-year class, it was ineligible for bonus. Now that they've corrected that and moved it back into the 15, it is now eligible for bonus. I will also note that bonus depreciation is 100% through 2022, after which it is scheduled to be reduced ratably 20% each year until it becomes completely phased out in the year 2027. Just a quick definition of what is considered qualified improvement property. Qualified improvement property is an internal improvement to non-residential property placed in service after the date the building is first placed into service. It specifically excludes elevators and escalators, internal structural framework, and enlargements to the building itself. Because this change was retroactively applied, the IRS released Revenue Procedure 2020-25, which provided 3 methods in which a taxpayer could correct what is now considered an impermissible method of accounting and change the class life to 15 years. These methods include 1, amending the tax return that has been filed for the year that the property was placed in service. You can also make the change with a current year tax return by filing a Form 3115 and making a 481A adjustment, which basically allows you to catch up that depreciation. That has to be done in a tax return filed within 2 years of the year that it was placed in service. Your third option is to file for an administrative adjustment request. So looking at some of those key provisions under the CARES Act, talk about some year-end tax considerations. I said before that the change to the net operating losses, specifically allowing you to carry those back, can provide a cash infusion by the way of a refund claim. It's also important to keep in mind that if you choose not to carry those back and you carry them forward, once you get past 2020, you're going to be subject to the TCJA rules again, which would put in place that 80% limitation. Looking at the changes to the excess business loss limitation and net operating losses, you consider the interplay there in that suspending the excess business loss limitation allows you to build that NOL. And then again, these things are taxpayer specific. So there's no one size fits all answer. And there's a lot of things that come into play. You think about the change in QIP. So you may want to build an NOL using bonus depreciation to carry that back. You may not want to carry it back because you might want to carry it forward into a year where you might have ordinary income that's taxed at a higher rate. So bottom line, it's important to talk to your tax advisor and come up with a plan prior to year end. The last provision that I will talk about is the deferral of employment tax deposits and payments. So the CARES Act allowed for the deferral and deposit and payment of the employer's Social Security taxes This applies for the period March 27th, 2020 through December 31st, 2020. Now we're almost at the end of the deferral period, so the next question you have to ask is, we have a deferral, when are these deposits due? Under the CARES Act, 50% of the deferred amount is due by 12/31/2021, and the remaining amount is due on December 31st, 2022. This is important to note because businesses need to be aware of what their cash flow considerations are, and they must account for that amount due that'll become due at the end of 2021. Now, from a tax perspective, there's also considerations you need to keep in mind. Because you've deferred these, depending on your method of accounting, it's going to dictate the timing of when these losses can be deducted. For cash method taxpayers, the deduction is allowed in the year that the deposit is made. So with that said, you're deferred until 2021 and 2022. If you don't make that payment in 2020, you will get no payment or no deduction for that amount. So depending on your cash needs and your specific tax situation in 2020, you may want to consider making a deposit for the end of the year so that you would have a right to that tax deduction in 2020. A little different for the accrual method taxpayers. The deduction is allowed when the all events test is met and economic performance occurs. Generally, the all events test is met as the employee provides services and the employer is legally liable to compensate them for their services. Economic performance for payroll taxes is considered to occur when the payment is made to the government. But there is an exception called the reoccurring item exception. It allows taxpayers to deduct the amount in the year that all events test is met and the liability is paid before 9/15 or the due date of the tax return. So the bottom line is that whether you're cash or accrual, if you wait until the end of 2021, when the final date that 50% payment is due, you won't receive a deduction in 2020. If you're cash method taxpayer and you pay it in 2020, you'll receive the deduction in 2020. If you're an accrual method taxpayer and you follow the recurring item exception, so long as you make that payment before the earlier of September 15th or the date your tax return is filed, you will be able to pull that deduction into 2020. So that covers some of the specific tax provisions of the CARES Act that are going away following 2020. I'll now turn it over to Lucas Rihely, who will talk about PPP loans and their tax treatment.
Well, thanks, Phil. As Phil mentioned, we'll be dealing with the PPP loans, its forgiveness and their tax treatment here. And the PPP loans had originated from the CARES Act, and Section 1106 of that CARES Act dealt with the loan forgiveness. And in that section, there was provision that specifically excluded the PPP forgiveness from gross income. So cancellation of debt is typically taxable, or at least it reduces tax attributes for taxpayers, and government grants are generally included in taxable income as well. So Section 1106 of the CARES Act made a specific exemption for PPP loan forgiveness from taxable income. Following the enactment of the CARES Act, a little more than a month later, the IRS issued Notice 2020-32, which essentially stated that expenses paid from the PPP funds that are ultimately forgiven are non-deductible. And the IRS, in applying the provisions of the CARES Act that amended the tax law, they added those provisions to the existing tax law and its regulations and found an incongruency with that specific loan forgiveness exemption and with what the IRS identified as Section 265 of the Internal Revenue Code, which essentially states that any amount otherwise allowable as a deduction, which is allocable to a class of income wholly exempt from tax, would be considered non-deductible. And that's the position that the IRS took in the IRS Notice 2020-32, which essentially made the PPP loan forgiveness taxable because the resulting expenses are non-deductible. So 6 months were on between the initial IRS notice stating its position and the subsequent guidance that was released couple of weeks ago. And in Revenue Ruling 2020-27, the IRS stated here that the taxpayer, if it reasonably expects forgiveness of the PPP loan, even if the forgiveness is not received until a subsequent tax year, the taxpayer may not deduct the covered expense paid or accrued during 2020. And in this revenue ruling, there was two situations given by the IRS. The first situation being that the taxpayer satisfied all loan requirements and applied for forgiveness prior to year end, but had not received notice of forgiveness by 12/31 or the end of the taxpayer's fiscal taxable year. And the second situation being that the taxpayer satisfied all loan requirements and had planned to apply for forgiveness by the end of its taxable year, but had not done so. So both of those situations, the fact pattern of those situations are important because the IRS is essentially stating that even though you have the tax exempt event occurring in a later tax year, that's still making these expenses in an earlier tax year in 2021 as non-deductible. So in the 6 months between the original IRS guidance and the IRS guidance that was released a couple weeks ago, there were several opinions on the deductibility of the expenses or what tax year they should be deducted. The IRS position now is clearly the expenses that were paid or accrued during 2020 should not be deducted in 2020 if the taxpayer reasonably expects a loan to be forgiven. So as an example of how this is going to affect taxpayers' taxable income, we have XYZ Co. that received a PPP loan for $500,000 during 2020. XYZ believes it has met all of the requirements of the PPP loan and reasonably expects the loan to be forgiven in full. XYZ closes its books for 2020 with a loss of $100,000. Assuming no other book-to-tax adjustments, XYZ's taxable income for 2020 will be $400,000, a positive $400,000 taxable income, which is a result of a $100,000 net loss per books and then adding back the $500,000 in non-deductible expenses. On the same day that the IRS released revenue ruling, the IRS also released this revenue procedure 2020-51, and this is dealing in the case of a taxpayer who had not deducted expenses in 2020 in anticipation of receiving loan forgiveness, and then in a subsequent tax year, that taxpayer is notified that their loan is either in whole or in part not forgiven, and there's going to be some amount of loan remaining to be repaid. So this safe harbor applies for taxpayers who met these following criteria. The eligible expenses are paid or incurred during tax year 2020. The taxpayer received a PPP loan, which at the end of 2020, the taxpayer expected to be forgiven in a subsequent tax year. And in a subsequent year, the taxpayer's request for forgiveness is denied in whole or in part, or the taxpayer decides never to request forgiveness of the loan. So having met this criteria, the taxpayer has essentially choices in which tax year to recognize some of these expenses. The taxpayer may deduct these non-deducted expenses on the timely filed original tax return or amended return for 2020. Or the taxpayer may deduct these non-deducted expenses on a timely filed original tax return for the subsequent year in which the denial of forgiveness in whole or in part is received, or when the taxpayer decides not to seek forgiveness. So if the taxpayer receives a determination that the loan is in whole or in part, the forgiveness is denied, then the taxpayer would run a calculation based on their 2020 taxable income or 2021 to determine in which year the deduction would give them the greater tax benefit. Of course, with the first bullet point here being deducting these expenses on the timely filed original 2020 return, this would be under the assumption that heading into the end of the year, the taxpayer expected forgiveness, but before it had filed its original tax return, or perhaps after, and then filing on an amended tax return, they were notified that the forgiveness was denied in whole or in part, and so they could take that deduction of those expenses in 2020 if that's to their benefit, depending on their taxable income for that year. So in this example, we have XYZ Co. again. They received a PPP loan for $500,000 during 2020. As of December 31st, 2020, XYZ reasonably expected the full amount of the loan to be forgiven and files its 2020 tax return, treating these expenses as non-deductible. XYZ later received notice that only $450,000 of the PPP loan is forgiven. To claim the $50,000 non-deducted expenses, XYZ may either amend its 2020 return or deduct the non-deducted expenses on its 2021 return. Now, if the taxpayer received notice of the denial in 2022, that would be the subsequent tax year that they could deduct these expenses. But in this example, it's 2021. And once the taxpayer had received notice of the denial in whole or in part, it's at that time that repayment of that remaining balance begins. So in reviewing some of the congressional response to the IRS positions, after the IRS released Notice 2020-32, Congresspersons expressed frustration with the IRS, stating that it was not the intent of the CARES Act to have these loans be taxable. One congressperson going so far as to say, why did we even waste the ink in writing that specific exemption provision if the IRS was going to simply make these expenses to be non-deductible? In May, there was a bill introduced in the Senate to make these expenses deductible. A similar bill was introduced in the House. No further action on these bills were made other than garnering some bipartisan co-sponsorship throughout the year. As recently as last month, the bill's up to about 35 co-sponsors, but again, no further action has been taken. And on November 19th, one day after the recent IRS guidance, Senators Grassley and Wyden, Grassley being the chair of the Senate Finance Committee and Wyden being the ranking Democrat on that committee, they issued a joint statement urging Treasury to reconsider its position while stating the potential for the fix to be included in the end-of-year legislation. However, no further congressional action has been taken to date. Without action by Congress, current IRS positions are that these expenses are non-deductible, with the revenue rulings and revenue procedures generally considered precedent for taxpayers in the IRS, but are not binding on courts. So if a taxpayer is considering taking a position to the contrary of this IRS position, there would be a probability of this winding up in tax court, and I don't know if a taxpayer wants to be the first in line to have this arrive in tax court under the specific PPP forgiveness deductibility issue, in understanding what the IRS position is and the associated costs with going to tax court. But looking back at the IRS position, they're essentially saying if the intent of the law was truly to make these expenses deductible and maintain the loan forgiveness being tax-free, we have these provisions in the existing code that prevent that. So Congress needs to enact another law to fix that oversight. So since the IRS position was initially released in April, and even more so now that the IRS has essentially doubled down on this position, the AICPA, other concerned groups, a lot of small business lobbies are lobbying Congress strongly to act regarding the deductibility of expenses. Again, no further congressional action has been taken. The stimulus bill introduced recently did not have the PPP expense included, unfortunately. So we'll look to see, and we're monitoring whether it'll be included in some ultimately agreed upon stimulus package or perhaps put through as a clean bill. That's something we're keeping our eyes on. So the guidance that was released by the IRS still left several open questions. We'll cover a few of those here. First of which is, how does this non-deduction of expenses affect Schedule C taxpayers? Those specifically being Schedule Cs with no payroll. They have their loans and the ultimate forgiveness based solely on the net profits of their Schedule C. This scenario applies similarly to certain partnerships. The guidance does not address an equivalent of making these loans taxable to the Schedule C taxpayers and partnerships. So this is, as of now, our last bastion of truly tax-exempt forgiveness is in this area, and it remains to be seen whether the IRS will address this. I will say that for Schedule Cs and partnerships that have employees, when completing your application, you want to ensure that you're building into the costs that are being applied for forgiveness, that you're including what's called the owner compensation replacement, which is essentially the Schedule C net profit or the self-employed earnings of the partners in a partnership, including those in the application for forgiveness, in hopes that if the IRS remains silent on the treatment here, that you would receive at least some truly tax-exempt benefit from these programs. So which expenses are considered non-deductible? As you're putting together your application, you'll be listing payroll costs, and you have the ability to selectively include non-payroll costs that were allowable under the loan. So if the total expenses of that were associated with the loan and being claimed for forgiveness exceed the loan amount, how exactly does the non-deductibility get allocated amongst these various types of expenses? And the reason this is important, and the reason that some strategy may be involved, is that the non-deductibility of expenses may affect your qualified business income deduction calculations, your R&D tax credit calculations, or your interest expense limitation calculations. So you want to speak with your tax advisor potentially before submitting the application. There could be some strategy involved. In the case of fiscal years ending within the covered period, how are the non-deductible expenses allocated between years? This is still an unanswered question. With June 30 year ends and fiscal year ends occurring in the midst of a covered period, 3 potential positions could be taken, with considering the PPP loans being spent first, making the front loading the non-deductible expenses into the tax year ending during 2020, prorating the expenses with a proration of expenses occurring before the end of the year and after the end of the year, or backloading the expenses. Those are positions that you'd want to discuss with your tax advisor as you're submitting for the application or preparing your returns or estimated or extension payments. And 2 last questions we'll cover today before I turn it over to Bill for some year-end tax planning is: which period is the recognition of tax-exempt income appropriate, which would affect certain basis calculations? And this is something as tax advisors we monitor on an annual basis. Basis is very important in our pass-through entities. With tax-exempt income, reading between the lines on the revenue rollings, it seems that the tax-exempt event is set to occur in 2021, and that's the view of the IRS and how they'll be treating that, and which may mean the tax-exempt or increase in basis would occur in 2021. And those calculations and positions is something we're, again, monitoring and we'll be discussing with our clients as we prepare the 2020 returns. And lastly, how are these treated for PA income tax purposes? PA has not made a specific bill or guidance related to the PPP loans. So for corporate net income tax purposes, which follow the federal taxation principles, unless there's a specific exemption, which for this there's not, the PPP loans would be considered the expenses non-deductible, and the forgiveness excluded from taxable income. For personal income tax purposes, cancellation of debt for PA is included in income, which would allow the associated expenses to be deductible, which again, in this case, may be occurring in 2 separate tax years. So those are some areas that are still open, we're keeping our eyes on. And with that, I will be turning it over to Bill to cover some year-end tax planning considerations.
Okay, thank you, Lucas. And good morning, everyone. I want to first compliment Paul, Phil, and Lucas on an excellent job of updating you on the events of 2020, some of the opportunities, a lot of the uncertainty that's still out there. And I think we're going to still be seeing a lot more here before year end and into the following season on many of these issues. For those of you who've already begun your tax planning or who've been reading articles and commentaries on this year, you've probably caught, again, this theme of uncertainty and taxpayer dilemma. And the question overall seems to be is, will the normal year-end tax planning strategies apply and be appropriate in 2020? And what I mean by the normal tax planning strategies is I've listed them out here, the approaches to deferring income, accelerating deductions. These are the old tried and true ideas, for example, with individuals, bunching deductions, businesses, writing off your bad debts, writing off inventory that's slow moving, all guided to or directed to increasing expenses, lowering income. Charitable giving is another area, a favorite for many people, and then the harvesting of year-end losses. Again, I'm going to repeat what I think the other presenters have said. It's very important to start talking, if you haven't already, with your advisor and begin planning and doing calculations. I mean, we as CPAs have sophisticated software that can help get you some answers very quickly on various scenarios. But what I think overall is, for many taxpayers, the normal strategies will again be appropriate, but for a select group, and we're going to dive into that, you'll see that they may not. So let's start now with first what I think is the fundamental analysis and the questions you need to be asking yourself and going through in planning. First is, how has the pandemic affected you? And now I'm not trying to insult you in any way, because I know if you have felt the pinch of a lower paycheck or reduced business profits, you know how it's affected you. But there's a lot of other things out there that may be more salient that you need to be asking yourself. For example, what's your dividend income going to be? What are your investment portfolio returns going to look like this year? I think for many people who have balanced portfolios, there may not be significant changes, but for others who might be weighted in certain areas, you might see lower income this year. So you want to possibly be getting in with your investment advisors before year end and understanding that. How about those of you who are heavily invested in rental properties? How has the decline in the economy, the unemployment, those things, how are they going to be affecting your rental property? And finally, the most unexpected surprise, and one for the positive, I suppose, is that we're looking at a market trading at 30,000, and what impact will that have on your realization of capital gains this year? The second question is are these opportunities, these benefits of the CARES Act, going to benefit you? Yes, they were enacted to help taxpayers, but unfortunately, they may not help everyone, and we're going to see some of that as we go through. So you need to look at those. The forgiveness of the PPP loans and the effect on taxable income, as Lucas explained, is a major unknown, and it's causing a great deal of uncertainty and confusion. And then finally, the uncertainty with next year with the new administration and the tax rates. And as Paul mentioned, we've got some pretty big changes being talked about. So let's first start looking at how the PPP loan forgiveness will impact your taxable income, and how it might affect your tax planning strategies. Well, I see three things happening, and this is very logical. Your forgiveness income or the non-deductible expenses will reduce a taxable loss that you have incurred. In the second and third situations, you might see an increase in income where a loss turns into taxable income, and a company who has been minimally impacted by the pandemic is going to report much higher income. And believe it or not, there are some companies out there like that. I think those in the second and third categories, you're going to find the traditional year-end planning strategies work for you. And again, the scope of this program is we can't get into each and every one of those. But again, I'm sure you're very familiar with some of those strategies over years and how to reduce your taxable income. Those following in the first category might have a slightly more difficult situation. And again, that is going to depend on whether these losses are going to benefit you. So let's let's move on now and first go back over the CARES Act and the points that Phil brought up, and I'll elaborate briefly on a few of those. And again, these were designed to provide immediate cash flow to taxpayers and an opportunity to shore up businesses and their balance sheets in part. The 5-year carryback and the elimination of the excess business losses, again, are limited to the 2018 to 2020 years. Phil explained those very well. He also mentioned the qualified improvement property. And that's an area that if you are have heavily invested in it in these 3 years and you haven't made a change, or if 18 and 19 years remain filed, you really want to look at this soon and determine what makes the most sense for you, because you can grab those deductions now and hopefully increase an NOL if that's going to be benefiting you. There were also some changes made to the limitations on charitable contributions for individuals. The 60% AGI limitation on cash contributions is eliminated. So you can now make up to 100% cash contributions to qualified charities. On corporations, the taxable income limitation has been bumped up from 10 to 25%. And finally, you'll also probably know that anybody who's a non-itemizer can get that $300 deduction for charitable contributions, but I remind you, you still need the documentation. And then finally, the CARES Act provided for the elimination of the minimum distribution for 2020, which is for some, I've already acted on it. It's going to reduce your adjusted gross income this year and hopefully provide you a benefit that we'll be talking about shortly. So let's look at the NOL situation just a little bit closer. You got to understand first is whether or not this NOL is going to benefit you. And there's a very good article in the Tax Advisor this month that discusses a number of issues related to the NOL carryback. I mean, first of all, when you go back 5 years, you're getting into a time period where you hopefully can still access your records. But you have to understand what effective tax rate you paid in those years. If you were a lost taxpayer or if you were in a very low effective tax bracket, carrying back the NOL may not benefit you. And you also have to take into consideration the impact the NOL is going to have with respect to AMT, which was in effect those years, and the potential loss of tax credit recapture. So again, to carry an NOL back, it will definitely impact and help those in higher tax brackets, those with larger amounts of taxable income. If you don't have that situation, then you've got to be a little bit more careful. Now, if you don't carry the NOL back, as Phil mentioned, obviously you're going to have that option to utilize it in 2020 or to carry it forward. If you do opt to carry it forward, there is a specific election that needs to be filed with your tax return. But the point I want to focus on is it better to try and use that NOL in 2020? As Phil noted, if you don't use it in 2020, it's going to revert in 2021 to the old rules, which limit you to the 80% amount. And so you get into a analysis of, do I hold it do I try to accelerate income and make that NOL work for me this year and work for me now? Okay, so we on next page. Okay, the taxpayers benefiting from the NOL ought to be looking at your normal tax planning opportunities to optimize your losses and to get the carryback and the refund currently. Again, I mentioned the opportunity now to go back and reevaluate your QIP. Make sure you take a look at that and see if you can grab some of those deductions in 2020. Two cautions I do want to throw out is one, that if you are going to consider strategies involving compensation and the acceleration, you have to be careful on the effect on cash flow. Okay, you want to make sure that you plan and manage that correctly. And then secondly, as you reduce your taxable income, you're going to hit you're going to result in lower AGI limitations, which are going to limit your ability to deduct those charitable contributions, which could be part of your strategy. So I mentioned accelerating income, and quite frankly, in most situations, people would look at you as though you lost your mind if you were to suggest this to them. But there are now in 2020 places where this can actually help you, and that's was the point of my original comment about the taxpayer dilemma. If you're not going to be able to benefit from the loss carrybacks, is it better to utilize those losses currently to offset income? Number one, you would avoid the future increase in taxable income rates, especially for corporations that are going to jump by almost 30%. And then for the individuals facing those potentially higher capital gains rate. Increasing your taxable income and will also allow you to make larger charitable contributions. For individuals, a key planning strategy for some is that your lower AGI is going to provide an opportunity, especially if you've deferred a required minimum distribution, to do a Roth IRA in 2020. And again, that benefits you potentially by having now two buckets of assets to draw from in order to manage your taxable income in retirement for future periods. And then finally, the last item is that if you can manage it correctly, you can ultimately get your your capital gains potentially taxed at a 0% rate. And again, you would have to look closely at your portfolio and manage this process with your advisor. When I mention income acceleration, there's a few ideas out there that you can take into consideration. One is to elect out of installment sale treatment. If you sold an asset this year and you're going to recognize taxable gains, you can increase your income, use those losses in this year if you elect out of the installment sale. A second option is to avoid like-kind exchanges. Make it all taxable in the current year. And this is a very common play in real estate. But again, if you're going to generate taxable income, you can use now and offset it with losses. Take a look at it. Electing out of bonus depreciation, exercising stock options, harvesting your capital gains, and declaring dividends at C corporations or other ideas that you can employ before year end to attempt to manage that overall taxable income portfolio. The final point I want to bring up is that you still have some time to evaluate your estimated tax payments. If your 19 payments were based on a safe harbor from 2019, you may wind up owing the government more than what you're due. So you could still look at that fourth quarter and adjust that payment. But again, I want to emphasize the need for working with your advisor and making the proper adjustments, proper projections to make these decisions. You always have an opportunity at year end to do withholdings additionally from wages or bonuses if you're going to get them. Kind of the converse here, if you believe you would need additional withholdings. And then finally, and I apologize in this last bullet point, it should read evaluate your 2020 payroll. It should be 2021 payroll withholdings now. Again, this is a good time while you're doing your planning to talk with your advisor and go over that. And Joe, I think at this point, since we're at the end, I'm going to stop and give time for any questions.
Thank you, Bill. So, as Bill referenced, we are right at our initial allotted time, but our professionals did agree to stay on the call post our allotted time if there were any questions. And we did receive a couple while the presentation was occurring via the chat. So I'm going to ask those questions, and that'll also provide time for anyone who has any additional questions to submit one during the via the chat feature. The first question, Lucas, I'm going to send it to you, mostly because it is regarding the PPP loan, and you did address the fact that Congress has not passed any laws to address the deductibility factor. But the question comes into play, and it's putting on your crystal ball. In your opinion, if they address it early next year, as far as when the new administration takes over, but they make it retroactive, how effective can the tax planning actually be, since the tax plan would have to be done this year?
That's an excellent question. That's something that we've been discussing quite a bit internally, because as you can imagine, the size of some of these PPP loans, or at least the size of the loan relative to the taxpayer, can swing the projections substantially. And in running tax projections, what we've often done is preparing two projection scenarios, one assuming that the law will stand and that the non-deductible expenses will stay non-deductible, and one projecting if Congress does fix the provision and show the expenses as deductible. And at that point, it becomes a question of cash flow and risk tolerance for the client in terms of making estimated tax payments, assuming that the expenses will become deductible, and if they later stay as the law currently stands as non-deductible, then dealing with the estimated underpayment penalties associated with underpaying your estimated payments. So those are the conversations that we would have with clients regarding that. In terms of probability of whether Congress acts, that's something that I really can't assign a percentage to.
And just to clarify, there's a couple more PPP loan questions that came in while you're talking, Lucas. Could you restate, in regard to the Commonwealth of Pennsylvania, will or will not the PPP loan be taxable if it's forgiven?
Yeah, so as it stands, the Pennsylvania, for corporate net income tax purposes, follows the federal taxation, unless there's a specific exemption for which the PPP loan, there is not one at this moment, which means that the PPP for the corporate net income tax, PA will just follow what the federal government does. For personal income tax purposes, there is a bifurcation between federal and PA treatment, because PA does not by default follow federal treatment. So for the cancellation of debt that the PPP loan forgiveness will be treated as of now, it'll be considered taxable income. The expenses associated with the PPP loans as of now will be deducted.
And I believe this question So the question is, how should PPP loan interest charges that are not payable, like the principal loan amount, be treated? I believe that would be if the loan is not forgiven.
So once the taxpayer receives notice from the SBA that whatever amount is remaining to be payable, so if a taxpayer received a $100,000 loan and it's determined that none of it's forgivable, or 80,000 is forgivable, so there's a $20,000 loan. At that time is when the repayment schedule begins. That's the earliest point, or 10 months following the end of the covered period by the terms of the loan, in terms of the program. That's the last date the loan repayment would begin. So the loan terms is the 1% loan. The interest accrues from the date of the disbursement. And it accrues on the amount that's ultimately not forgiven. And the loan term would be either 2 or 5 years, depending on the loan agreement. That did change on subsequent legislation. They extended the loan term to 5 years, but only on loans that were created after that legislation. Although it did say that the borrower and the lender could agree on the longer loan term for loans that were under 2 years under previous legislation.
Paul, this question is in regards to the upcoming Biden administration and some potential changes to taxes. And of course, you referenced this, that no one has a crystal ball, but there might be some increases, or possibly likely due to your earlier comments. But the question is, any specific advice for the year end? Specifically, should there be considerations of converting IRAs to Roth accounts to paying the taxes today instead of later down the line?
I definitely think that's a important consideration. As Bill went over, that with the RMDs not being required this year for people that are withdrawing in that period where they're required to take money out of their retirement accounts, if they elected to utilize that and not recognize that taxable income this year, this might be a good year to move to some of their retirement money to a Roth. Whether it makes sense for people who don't have the RMD situation to convert, I think that's a case-by-case basis, depending where your income's at. Certainly, if your income is going to be in that category of over $400,000, that probably makes a lot of sense, because you're likely to have a near-term increase in your income tax rates. But with that said, you want to look at, does it make sense if you're 20, 30 years from retirement to accelerate that tax now? So it's a complex argument, but I think the simplest one is, if you went to forego your RMD this year, it really makes sense to seriously consider a Roth conversion.
I cannot remember who touched upon the real estate element. I think it was Phil, and so Phil, if it wasn't you, just let me know. But the question was, what tax benefits are available for real estate improvements with the correction of the 2017 tax code? Phil, can you speak upon that? If not, maybe just suggest who should cover that question.
Yeah. Go ahead, Bill.
Okay. Well, I'm assuming they're referring to the QIP that Phil went over, and with they call it the retail glitch, and the retail glitch was part of the 17 Act that unfortunately took away the opportunity to take the internal improvements, the non-structural components, the things that many retailers do regularly with refreshing, renewing, new tenants and so forth, to get them into a space, or even a tenant themselves perform some of that work. The law was set up to do it. Unfortunately, it's threw them into the 39-year category, not available for the bonus depreciation. With the correction to that, those assets are now permitted to be treated for bonus depreciation, and the law gave them the opportunity to either amend a prior year return or file for an accounting method change currently to do that. So, I hope that answers it. And if anyone has something else to add.
At this point, that wraps up the questions that we have received via our chat feature. So I will turn over to Paul to close out the program. Thank you, everyone.
Well, thanks, everybody. I know we covered a lot of detail today, and some of it is somewhat complex. So we appreciate your time today to visit with us, and we look forward to having the opportunity to discuss some of these issues with you to address more specifically your individual effects of the taxation as it occurs today and what it looks like tomorrow. And I wish all of you a happy and healthy holiday season, and may you all stay safe and healthy in this challenging time.